Hi again, welcome back. Now then, oil prices. The media was full of it over the weekend when the drone strike on Saudi oil production spiked the oil price up by 20%. Of course, what the media, even this morning, haven't said is what the reaction was yesterday, which was actually a spike back lower to retest this high of around about $59 per barrel. That's as far as West Texas Intermediate Light's concerned, and where it's likely to be going after this. Furthermore, it would have been quite useful to have been told before the event happened that the oil price was starting to go higher, and that's exactly what our color-coded buy, sell and uncertain indicators were telling us, as you can see here. And really, since the beginning of September, it's flashed between buy and neutral and started to move away from this sell signal. So we were already on high alert for higher prices, and we prefer to tell you about what's likely to happen before the event rather than after the event. Moving swiftly on to interest rates, at least the ones that matter. Here's the chart that was included in our last week's weekly investment markets overview, which had actually been bagging on over the last month or so about how ridiculously low bond yields, US Treasury 5, 10, 30-year Treasury bond yields had been whacked out of context, hitting near 35-year lows, and it's been like an elastic band. And as you can see, in 1 week, this was the reaction last week. The 5-year up by 23%, the 10, which is effectively the US mortgage market, by 22%, and the 30-year by 17%. That's some move in 1 week. But of course, the media is all over the FOMC meeting later today, where they decide on the base rate. And here's the history of it over the last 5 years or so, where after a stair-stepping higher, the Fed cut rates at either the last meeting or the one before, and it's more or less unanimous amongst analysts that there's likely to be at least a 0.25% cut later today. But frankly, who cares? Do you know anybody that borrows at the FOMC base rate, or come to that, any other base rate from the Bank of England, the Bank of Japan, the European Central Bank? No. Us mere mortals, if we borrow or lend money, have to depend on the market rate. And what we show here is the Fed funds rate still in blue, the black line being the 3-month LIBOR interbank rate, which means the cost of lending or borrowing for a 3-month period. And as you can see, it's slightly different than what the Fed funds rate is. And what it does confirm, and I could repeat this for any central bank in the world, that central bankers have never made a proactive decision in their lives. All they do is follow the market rate up, and they follow the market rate down. So based on this, in the very short term, you can see that there's a good odds that there will be a quarter to, who knows, may even surprise at 0.5% cut when they meet this evening. Well, it's 7 p.m. UK time. But be careful what you wish for, because interest rates and the Dow Jones have been trending together, which isn't as most people expect. And as we can see here, when interest rates were flat, the stock market was fairly flat. Interest rates went up, the stock market went up, and over this latter period we've seen a leveling off of interest rates, and then the beginnings of that fall, with some uncertainty accompanied by the Dow Jones Industrial Average, the US stock market. We prefer to look at longer term picture, And what we have here, I mentioned just now that the 10-year Treasury yield is effectively the US mortgage rate. And whilst 1 week of a 22% jump is big, the 5-year weekly data chart tells us a little more. And here it is. So every one of these bars is 1 week, and it goes back 5 years. Look to the 16th of September in 2014 through to last week's closing price, and that's that spike. Well, what we can learn from this is that the all-time low in the 10-year Treasury bond yield was actually back in the middle of June 2016 at around about 1.37, and this ended a 35-year period of fall in interest rates. We then saw quite a hefty move all the way from that 1.37ish all the way up to 3.25, which is about 130% rise through to the end of 2018, when we had this crazy period where 10-year yields effectively collapsed. But notice they didn't quite go as low as where we were in 2016. And our analysis would say that this is the beginning of quite a large move up. And for guidance, we use here a Fibonacci retracement indicator, and that's telling us that we're probably going to be aiming for around about here. So if you haven't locked in and refinanced on your mortgage in America, now is not a time, not a bad place to do it, because that opportunity is going to disappear very quickly. Further guidance we use is supported by an old tried and tested head and shoulders pattern that's developed. And as we can see here, there's a sort of left-hand shoulder, a right-hand shoulder with a head shape here. And all we do with this is we put a neckline across here to give an indication of where we're likely to go, which is whatever that distance is there, it's likely to go the same the other way. So try 1.8% up to best part of 6%. Whoa, what's that going to do for both the stock market and the housing market? Stay tuned. Already though, the clues were there. We've seen this trend line down here, this green dash line was broken here. It's come back and retested that and gone back through. We need to see it now burst above this 3% maroon line, and then we're off to the races. So perhaps we can leave you with a quote from legendary investor Jim Rogers. Get inside information from the president and you will lose half of your money. If you get it from the chairman of the board, or should we say the chairman of the Federal Reserve, you will lose all of your money. We have to end with the obligatory health warnings, and until next time, safe investing.